Hey, did you know you could get 12 free stocks with Webull by signing up with metkevin.com/Webull? Click that link down below, get 12 totally free stocks. It's right next to that expiring coupon code for the courses expiring tomorrow. Hey everyone, Meat Kevin here. Still sick meat. But anyway, let's talk about why all of a sudden the market is rallying. This is like really bizarre. But we had terrible inflationary numbers this morning. Everything missed expectations. Like everything was worse than expected. And the market is not selling off like it had been. I mean, the NASDAQ at what point dropped 3%, and now all of a sudden it's just recovering. And now it's actually positive 1.8%. The S&P 500 was down over 2%. Now it's up 2%. Tesla was down as much as 4% intraday, and now it is up 2%. What? So, let's try to make sense of what's going on. There are a few reasons that I think we could be seeing this sort of rally. And we got to talk about whether or not this is just a bear market relief rally or what's happening. My first suspicion is that a lot of people went into the CPI report shorting and with put contracts, so derivative shorting. Now, why does that matter? Well, because those shorts paid off handsomely this morning, right at market open. Those shorts paid off very, very well. We hit new lows on the S&P 500, on the NASDAQ, and on many stocks. In fact, Tesla was at levels that we hadn't seen since the Shanghai shutdowns in the summer. That's pretty remarkable. And so, in my opinion, there's this potential that we could have seen in the market of short covering. That is, people shorted, they made money on their shorts, and then bought back their shorts, creating buying pressure. At the same time as those buybacks were happening and we started to see some of that rotating back to green, the buy the dip audience likely came in. Retail has still not been a net seller this entire year. And even though retail is running out of money to buy with, and the amount of money that they're investing is declining, on average we're somewhere around $900 million a day now instead of $1.2 to $1.5 billion according to Vandatrack. So we're definitely seeing, substantial decrease in the amount of money that the dip is being bought with. But you still have a lot of people on the sidelines ready to buy the dip. So potentially, right as we saw that short covering, I wouldn't be surprised if we started seeing, oh, nope, bottom's in, this is my opportunity to buy the dip. Now be careful, because these sorts of short covering relief rallies don't tend to last. So don't feel like just because there might be a short covering relief rally, markets are definitely at a bottom. That's not the sign that you want to look at. You'd be more accurate to say something like, hey, after midterm elections, markets usually perform better than they do before midterm elections. Sure, that is more true. After all, we have a beautiful chart on exactly that, showing us how beautifully markets tend to perform after midterm elections compared to before on screen now. But just because there's a short-term sort of relief rally after a sort of a crash that had a lot of short sellers going into it, not necessarily indicative of a certain bottom indicator. But there's more. Let's talk about the more part. Now, another interesting thing that's happening is we're actually not seeing the VIX, the volatility index, really hit these capitulation levels that you would really expect to mark a bottom. In fact, we've had a declining trend line here of peaks for the VIX. And it's really remarkable because if you go all the way back to March of 2020, the VIX ran up to 85. Now you do see via the MOVE index, which is basically the VIX for bonds, that volatility is like at massive peak levels right now, higher than what we've seen in March of 2020. But in terms of stocks, it's actually been very hard this year for us to hit new highs on the VIX. And I think that's because people see the light at the end of the tunnel, that at some point inflation is going to go down. It's just a matter of how much is it going to go down. So one of the places that we could see this, or sort of this expectation, is if we look at the St. Louis Fed chart for CPI, we can actually see what we need to lap to see inflation go down. Now, this is a really cool process. So look at this. Right now, As of September, well, which is the report we just got, CPI is sitting over here at a year-over-year change of 8.2%, right? Well, we have to, if we change this from percentages, let me clarify this. Let's change this from percentages, where right after the pandemic, we basically had almost deflation. I mean, virtually no inflation here. We saw the inflation really take off when we were comparing to the whole of March over here, February, March, April, when we were comparing to this whole, we really saw inflation take off from 1.6% to 2.6 to 4.1 to 4.9 and so on. We saw a temporary pause in inflation, but then we got hit with Delta, and then we got hit with Omicron, and then we got hit with war. Like, that's insane. Those are some insane catalysts for inflation, right? So let's edit this graph and change it to a nominal figure. And so what we're gonna do is we're just gonna take the index value, because CPI is not calculated based on a percentage. What CPI actually is just a base number that adds over time. It's how much did this basket increase in cost every single month, right? So when we change it to this number, what's interesting is we can actually compare, ignoring percentages for a moment, what level do we need to be at next year to be at 0% inflation? And what you'll notice here is that the steepness between May of 2020 and June of 2020 is pretty substantial. But ignoring the percentages for a moment, look how this growth in inflation has actually stalled. CPI only went from an index read of 1375 approximately to 1381. And so what's remarkable about this is we could see this rough inflection point here in June. And when we go back to June of 2021, we'll actually see that the index level was at 1261. So what's remarkable about that is if next June, we end up getting, well, let me just do that math for you really quick, just so you can see how this works. You go from June of 2021, 1261, over here to 1374. Watch this. 1374 is the new number divided by 1264. That shows you 8.7% inflation, right? Approximately. And what's neat is, if we stay at this inflection point until June of 2023, or roughly around there, let's say the index read goes to 1400 because it's growing relatively slowly. Well, a 1400 new number divided by 1374 would actually only be an inflation rate of, look at that, 1.2%. 1.2%. So this flattening that we're seeing of CPI is actually really neat. So look, the point of this chart is just to say that as we look at CPI and we compare it back to this slope, because the slope has been rising so fast, of course the numbers are going to be high when we compare them year over year. Now, one of the more problems or localized problems that we have right now is we are seeing certain segments like rents and medical services and food on a month-over-month basis. Those little segments are still growing, and that's really bad because you actually have those individual segments inflecting up. But on sort of an overall level, the rate of inflation going up has definitely slowed. It's not plummeting yet. It's not falling yet. We're not seeing that deflation yet, right? Where prices are actually lower than what they were previously. But we're clearly seeing disinflation in that the rate of the overall trend growth is down. So my belief is that there's a possibility the market is saying, you know what? We need to rally so everybody has money to invest in House Hack and Kevin's programs on building your wealth, with the coupon code expiring tomorrow at 11:59 p.m., where you get lifetime access. And if you buy afterwards, once the coupon code expires, you won't be getting lifetime access anymore, specifically in Path to Wealth course. But anyway, you already know about that. So I believe there's this potential that we have two reasons for this temporary rally that we're seeing right now. One is short covering, and number two is really hope. It's hopium. It's this hope that inflation, even though it's bad now, is this potentially just the last of the worst? Like, come summer of 2023, if we stay at this relative flat level, is it not likely that inflation will be substantially lower? And I think markets are trying to look forward through Q3 earnings and look into the summer. I mean, we just reviewed TSMC this morning in the course member live stream. We also reviewed Delta, and I have to say those earnings were great. Those earnings aren't telling you anything about any kind of slowdown, and neither are the earnings from Pepsi yesterday. Holy smokes, no slowdown over there, which is a concern that could actually prop inflation up. But when we just zoom out for a moment and actually look at this chart for headline inflation, it is slowing. And markets like to price this stuff in 6 to 12 months in advance. Well, about 9 months from now, in about 8 months from now, we'll be in June. How crazy is that? So we'll actually be having our June 2023 inflation report, and we'll probably look back at that inflection point. If we're still relatively similar, around 1,400 for that CPI, we're going to have a really, really low headline read. So hopefully that is true, and hopefully that's true at the same time as we start seeing owners equivalent rents decline. That would be great. And owners equivalent rents will go down. As the housing market goes down, I expect rents will follow down. It's just going to take another 6 months or so to get there. But again, with peak rents maybe being somewhere around the fall of 2022, maybe we'll end up seeing those owners equivalent rents come down 6 months later or somewhere around the spring, summer of 2023. But the same is true here. Just because there's hopium about that inflection on headline CPI numbers doesn't necessarily mean a bottom is in. So what's my strategy on this? Well, my strategy is simple. Stay out of margin, work hard, and continue to contribute to your portfolio. In my opinion, it's a lot less stressful than trying to understand all of the little fluctuations. And anytime there's an opportunity to go buy at a nice level, I'm going to do that. Even if it feels like I'm throwing money into a fire pit, I realize that in a year from now, 2 years, 3, 4 years from now, I'll probably look back and go, wow, wish I bought more at the bottom. Good news though is I've already done that because I got no money left. So I'll probably be saying, darn, wish I had more money to buy the dip at the bottom. Anyway, who knows? But these could be two potential reasons for somewhat of a relief rally. Do keep in mind, though, we have an earnings recession likely ahead of us. So while some companies might outperform, especially in my opinion, certain companies like Amex or Tesla or Lulu, companies with substantial pricing power, I do think the vast majority of earnings are going to be disappointing. We'll see. That does mean some potential further pain for markets. All right, folks, thanks so much for watching. We'll see you in the next one. Bye.